Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we are kicking off another earnings season after what has been a volatile quarter, where we started off the quarter basically near 52-week lows or at 52-week lows, and we've managed to basically rebound back to 52-week highs. Um, Last quarter was a particularly strong quarter for the S&P. Things are expected to slow down from last quarter. So let's currently review where we ended up for Q1 and what our expectations are for Q2 earnings coming up. Before we get started, just to remember that options involve risk, and it's important to understand your risk before you place any trades. Specifically, all investments involve risk, including the potential loss of principal. Options trading has additional risk and is not suitable for all investors. So make sure you understand your risks by taking a look at the characteristics and risks of standardized options brochure to hopefully help you better understand the risks involved with trading options before you utilize it for your portfolio. Now, what we're going to go over today here are, a preview of earnings for the second quarter of 2025. We'll take a look at kind of what have been the best and worst sectors for this particular earnings season, the earnings calendar. Specifically, what I want to walk you through is kind of my earnings research process to help me identify trades for trading earnings by going through a few live examples and looking at the optimal option strategies that you could deploy for earnings season. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can you maximize earnings season with confidence utilizing options. So let's take a look at kind of how Q1 shaped up for the quarter. Now, if you look at kind of how Q1 ended up, EPS grew by 13.3% year over year, when the market was only expecting about a 7% gain in terms of EPS growth for the S&P 500. So this is really where the market significantly outpaced, expectations. And I think this is probably because the bar was set a little bit low, for Q1. We basically saw some early reports in January, February that sort of pointed towards, what could potentially be a much weaker consumer, and markets were just expecting things to be quite soft. Ended up not being the case. Consumers ended up being significantly more resilient than I think almost everyone possibly could have predicted. So we ended up seeing a pretty strong, very strong earnings season last particular quarter, and we saw one of the fastest recoveries in the S&P 500 from those early April lows. So that's kind of what we saw here in the S&P 500. Revenue growth side, we ended up getting about a 4.9% year over year increase versus the 4.3% that we were expecting. So that's also a pretty significant uptick in revenue, and that's a strong result to see. Both top and bottom line beat estimates by a pretty strong percentage, at the end of the quarter. Margins also increased, to 12.7% when the market was expecting just under 12%. So that was a really strong showing from companies, S&P 500 companies, in terms of profitability. We saw 82% of healthcare and 87% of tech beat earnings, while 64% of utilities and 34% of energy stocks missed on earnings. So, we saw, we continue to see utilities and energy sort of trade near the bottom of the sectors versus, sectors like healthcare, technology, consumer discretionary continue to outperform in this particular market. And what was, in my opinion, most encouraging was the fact that stocks that beat on earnings saw a pretty significant move to the upside, and stocks that missed on earnings saw a pretty significant move to the downside, but it was very well balanced. And that's a good sign, because for quite a few quarters we were seeing somewhat unbalanced um, s- uh, results of how stocks performed after they beat or missed on earnings. And looking at kind of the Q2 preview, right now the market is expecting that we'll see about nearly 5% EPS gain. So, like I said, that's a pretty meaningful slowdown from last quarter of 13.3% growth in terms of EPS. 4.9% is pretty low. In terms of revenue growth, we're expecting very similar to what we expected last quarter. Maybe we see a little bit of a beat here, but so far, we certainly expect the market to slow down from last quarter, and we'll see whether or not we that actually happens. This is obviously the quarter of huge amount of uncertainty with regards to tariffs, and that is part of why the market has such a low bar that's being set here for this particular earnings season. Technology and real estate are the sectors that are seeing the best revisions ratios, meaning these are the sectors where analysts are revising their expectations higher, or at least there are more stocks in these particular sectors where analysts are expecting, or I'm sorry, have revised their metrics higher versus lower. And then energy and utilities are seeing the worst revisions ratios, where we're perhaps seeing more analysts revising expectations lower than they are revising them higher. So looking at kind of this particular earnings season, that gives us a little bit of a roadmap as far as where we can potentially see some potential gains and where we could potentially see some losses from the different sectors. Now, one thing that I think is really important for investors to always kind of keep in the back of their mind is the fact that the S&P is now trading at 22.3 times forward earnings. That's a pretty significant multiple higher than the long-term average. It's around 118 and a half times forward earnings. We're talking about, the market trading at around 22% higher than the long-term average from a valuation perspective. And this is something, like I said, that we should always have in the back of our minds as we look at the S&P 500 at all-time highs, and we ask ourselves, do we think markets can continue to make new all-time highs and continue to go further? From a valuation perspective, 22 times forward earnings is certainly high, but not an extreme level. We have certainly seen higher multiples in the past. So, things are stretched, things can get even more stretched before things really kind of fall apart to some degree. So those are some of the things that, even though valuations are stretched, it doesn't mean that it's time to short. It doesn't mean that it's time to be bearish on the market. It just means that it's important to understand that upside can be somewhat limited when valuations are already stretched to the upside. Now, for the stocks that have reported so far, it's been a pretty decent earnings season. 71% of early reports have beat on average. But the number that really stands out is that 81% of stocks have a beat on revenue, which is, I'm sorry, 80, yeah, which is really a strong result here. And arguably, revenue is more important to see beats on, because you can't manufacture revenue. You can only manufacture, or you can manufacture EPS to some degree by lowering expenses through taxes, through, multiple ways that you could potentially make EPS look perhaps stronger than it really is. But you can't do that with revenue. Revenue is revenue. So for those reasons, I think that so far what we're seeing is a pretty strong earnings seasons based on the early reports. Now, it's obviously based on just a few stocks, so not quite enough to make a decision on that, but off to a good start for this particular earnings season. And what's even more encouraging is that stocks that have beat on earnings have gained on average around 5.2%, versus stocks that missed have only moved down by about 1.3%. Now, obviously, I don't expect this skew to remain so skewed, throughout the earnings season, but with a few names that have reported, this is a relatively positive development that we're seeing here with the broader markets. So, with that, let's take a look at kind of a process for identifying stocks for trading earnings season, because I always get asked this question a lot with regards to, there are so many stocks that report on earnings every single day, every single week. How do I pick, which stocks to trade? How do I have a sense for where, I think stocks are going to beat on earnings, where they're going to miss? So I'm going to want to walk you through my process for identifying stocks that that I'm going to trade on earnings. Now, if you follow this process, you'll see that it filters out, 95, 97% of all, reports. So it really helps you cut through the noise. You very well will miss out on some opportunities. There's no doubt about that. But my selection, the way that I look at things, is very selective, and it gives me kind of a high conviction on the trades that I make, on the few that I do manage to find. So, when I'm looking at earnings opportunities, I always look for two things from a technical perspective. What I like to see is the stock, if I'm taking a bullish view on a particular stock, is one, I like to see absolute strength, meaning I'm seeing that it's outperforming the stock relative to its own history. So this is Moderna. As you can see, Moderna has been range bound between, call it $24 and $29. So it's a $5 range that the stock has been trading in. And specifically, this is a stock that has underperformed for a long period of time since, and then over the last, call it 3 months, it has entered this kind of sideways consolidation, and just recently it started to break out here, right? So that's what we consider absolute strength. We're just looking at the stock compared to its own history and what direction it's trending in. Obviously, if it's trending higher, you're more likely to take a bullish view. If it's trending lower, you're more likely to take a bearish view. But a stock trending higher in itself is not enough, because what if every other stock in the market is trending higher, right? Just because you're going along with the market doesn't mean it's a great trade to go into earnings. So what I like to see is relative strength, right? So I look at kind of how the stock is performing, not only relative to itself, but relative to the overall market. And what you really want to see is a breakout or some type of move to the upside that's being confirmed with strong relative strength. And that's what we're seeing here in Moderna, right? It broke out here, but it didn't just break out because the rest of the market was moving higher. It broke out and moved faster than the rest of the market. That's the relative strength aspect of what we're looking at. Another example of this is T-Mobile, right? This is to the downside. Basically, as you can see, T-Mobile has been trending lower here for the last, call it 4 months or so, and recently broke down below some major support levels at 230. These were levels that have held prior, but then have now we're breaking down below those levels, and we want to see that not just breaking lower, but we want to see relative weakness here as well. So meaning stocks aren't just moving lower with the rest of the market; they're moving lower faster than the rest of the market. And because the markets are moving higher right now, any stocks that are moving lower at this moment will have poor relative strength. But these are some of the things that you want to look out for if you want to take a bullish or bearish view on a specific stock. And I specifically want to see, absolute and relative strength aligning with each other, because that gives me a good sense that not only do I have a directional view, but it looks like there are more participants in the market that also agree with my directional view, and they're either buying the stock up faster than they're buying index funds, or they're selling the stock faster than they are selling their index funds. And that kind of gives you some sense for how institutions or the rest of the market is sort of positioning in this particular stock going into the earnings announcement. And then once you kind of have identified the stock from a technical perspective, I always find that it's important to have a sense for the business from a fundamental perspective. And there is no right or wrong way to do this. There certainly isn't a black and white way to do this. It's really every single person may have their own sort of process. For me, what I really look at is valuations and the underlying, key metrics that support that valuation, which usually are, if you've attended my Tuesday morning market outlook sessions, which I host every Tuesday morning at 8:30 a.m. here at First Trade, is that I walk you through the fundamentals, the valuation, the growth expectation, and profitability. Growth expectations and profitability, those two things are largely the biggest inputs into, my views from a valuation perspective. So if you look at T-Mobile here, T-Mobile trades at 21, 22 times forward earnings, which is effectively double the industry average. If you look at kind of growth expectations for T-Mobile, it absolutely exceeds the industry average. You're looking at EPS growth around 15, 16% versus the industry's around 5 or 6%. You're looking at revenue growth around 5% when the rest of the market is around 2.5%. So you basically have, growth metrics that are either double or to potentially triple what the market is currently expecting from its peers. And on top of that, T-Mobile's more profitable than its peers. So by all accounts, T-Mobile is justified in trading at a valuation that's higher than the industry, which is again around 10 times forward earnings. But does it make sense for it to be trading at 22 times forward earnings because it grows faster and is a little bit more profitable? That's where I have a hard time agreeing to that, which is why T-Mobile is one of the stocks that I'm taking a bearish view on going into earnings, because T-Mobile, as I showed you in the previous slide, is breaking below support levels, underperforming the broader markets. These are the signs that I look for from a technical perspective. And then the fundamental story here for T-Mobile looks quite overvalued. And that's why when T-Mobile reports next week, this is an opportunity for me to take a bearish position here in T-Mobile. Okay. So, and when you use this type of process to look for trading opportunities, you'll see, that it filters out the vast majority of symbols on a given day. And from my perspective, that's a good thing, right? Because if I have a scan or an earnings scan where I have 40 different stocks that I could potentially take, well, it's really difficult to look through 40 different stocks and identify which one's best. So chances are you don't. You just kind of eyeball it and hope that you found the best one. Versus if you take a very stringent process where it only identifies one or two stocks a day, you have the opportunities to kind of dig a little deeper and potentially trade those utilizing potentially options. So with that, what I want to walk you through is kind of, if you've identified a stock that you like from a earnings perspective, how should you trade it utilizing options? And I'm going to break it down two separate strategies. I'm going to talk about a debit spread and a credit spread. And I'm specifically going to show you a special type of debit spread. I call it a 3-by-1 debit spread. And these are strategies that use only when you expect a strong directional view. And, and a lot of people say, how do you have a strong directional view? Well, the process that I just talked to you about, where I look for, relative, absolute strength, relative strength, and undervalued stocks, or vice versa, if I'm looking for uh, weaker, relatively weak stocks that have underperformed the S&P 500 and their valuations are sort of quote unquote ridiculous. Well, that's really where I, have a tendency to take a bearish position on. So I'm going to use T-Mobile here as my example here. And when you use this kind of debit spread variation that's specifically used for earnings, when you have a strong directional view, you do make modifications to the standard debit spread to account for the fact that you're trading earnings and you're trading something that has, a binary event. So when you're using a debit spread for a binary event, I like to use a 3-by-1 debit spread. So what I'm doing is I'm going out 30 days from expiration and I'm looking at buying an at-the-money call or a put. Because T-Mobile is a bearish view, I'm going to look at buying out of, an out of the money put option. And then I'm also going to sell a further out of the money call option against it around a 16 delta. And so what that means for T-Mobile is going out to the August 15th expiration, which is 30 days from expiry. I'm buying the 220 puts, which are, roughly $6 below the current price of the stock, and selling the 210 puts against that. And earlier today, you can pay about $2.59 for that $10 wide debit spread. And for everyone who can remember my sessions where, whenever you're trading a vertical spread, what you're risking is fixed, and what you could potentially make is always going to be the difference between the strike prices minus your total risk. So it's really important that you kind of be mindful of these specific um, risk reward ratios as you're using these for earnings, because when you're using these types of strike prices, you're going to get roughly 3-to-1 risk to reward ratio, which is why I call it a 3-by-1 debit spread. So as you can see, for a $10 wide debit spread, this is costing me roughly $2.59 at the time. That's just about 1/4 of the vertical spread that I am buying. And this gives me that 3-to-1 risk to reward ratio if the cost of the debit spread is roughly 1/4 of the vertical width. Okay. So in this particular case, I'm risking $259 to potentially make $741. So if T-Mobile declines on earnings below $210 by that August expiration, I'm looking at a maximum gain of around $740. And worst case scenario, T-Mobile doesn't move lower and the stock stays where it is, or even it moves higher, my total risk is limited to $259 per contract. So again, a risk reward ratio of roughly 3-to-1. If T-Mobile's above 220 at expiration, I lose $260. If T-Mobile's below 210, I'm making $740. Those are the types of risk to reward that I like to see going into earnings. That's effectively a binary event. And ultimately, I don't know where the stock will land at expiration, or after earnings. So it's important that I have a risk to reward that is favorable for that kind of binary event. Okay. And then lastly, you can sell a credit spread. This is another type of strategy that you can do. And this is more popular for, when implied volatility of options are very elevated, that you can collect more premium. So if you look at T-Mobile here, the IV rank here, T-Mobile, the IV rank here is 42 out of 100. So options are certainly on the slightly expensive side when it comes to selling options. So in this particular case, I actually think it makes quite a bit of sense, if you're bearish on T-Mobile, to look at selling some call spreads. In this particular case, when the stock's trading at 226, I'm selling the 225 240 call spread. That's a $15 wide credit spread. And as you can see, I'm collecting $6.20 for that credit spread, which, if you look at kind of the optimal credit spread, you want to collect at least 1/3 of the width between the two strike prices. Here, 1/3 of that vertical width would be $5 because it's a $15 wide credit spread. But here I'm actually collecting $6.20, which is meaningfully higher than the bare minimum that you're looking for these types of strategies. And what this gives you is a risk reward ratio. It's about 1.5-to-1, right? So if T-Mobile stays below 225, you keep the $620 per contract. But if, let's say, T-Mobile is above 240, right, which is, a fair clip higher than where it's trading right now. But if it ends up at 240, then your maximum risk is $880. So with the credit spread, you do have negative risk to reward ratio, but what it does is it gives you a much higher probability of success. Those are the different trade-offs that you make between debit versus credit spreads. Debit spreads, you have a low probability of success, but you have a risk to reward ratio that's much more favorable. And then credit spreads, you have a probability of success that's far more favorable, but the risk to reward ratio is less favorable. Now, one is not better than the other. It's about understanding when you might want to use one type of strategy over the other, because debit spreads are for the stocks that you think are going to make a big move in a short amount of time, versus credit spreads are more so for the stocks that you think, you're going to see more muted reactions from those particular stocks, because maybe these are stocks that don't generally move a whole lot, or these are stocks that you just don't believe the stock is going to meaningfully beat or miss on earnings, and you think the stock's going to make a relatively small move. Then in that particular case, you might want to look at selling some premium like you do here with a credit spread. So with that, what that covers is effectively, a quick review and overview of what to expect for this upcoming earnings season, how you can potentially identify the best trade ideas going into earnings season, and then more importantly, how you can trade it with limited risk, so you know exactly how much money you can potentially make or lose on every single given trade before you execute and place that trade itself. Um, and so with that, what I'll do is I'll open this up for Q&A. I hope that this is helpful in giving you a better understanding of just how to think about earnings season, because earnings season many times, like I said, can be quite daunting. There's a lot of reports that are coming out in a short period of time. There tends to be a lot of volatility, and it's hard to figure out how to navigate all of that. So what I'll do is I'll open this up for Q&A. If you have any questions, please type your questions into the Q&A window, and I'll try to answer your questions through that. Um, if there are no questions for today, then I'll just thank everyone for taking your time this afternoon. I hope this is helpful. Um, I hope that this is helpful in giving you a better understanding. Looks like I forgot one question here. Arthur's asking, what's the strategy for stock rising? So it's the same strategy, right? You would just flip it from bullish to bearish, as opposed to looking at bearish strategies. You would look at it from a bullish strategy perspective. So a debit or credit spread both have bullish debit spreads and bullish credit spreads. You would simply choose the bullish version of those specific strategies versus the bearish version. I'm just using T-Mobile as my example, which happens to be a bearish trade. But if you look at kind of my Moderna example, you would use a bull call spread for a debit spread, or a bull put spread for a credit spread. So same strategy, but just different direction. What are some tips on managing the setup? Close the position right after earnings or until it reaches some target profit or loss? So I would generally say that it's more common to use a stop loss or take profit level to decide whether or not you are going to adjust a position after earnings. Now, however, if the stock has reached sort of your objective, or has reached your, one of the strike prices in your strategy, you generally might want to adjust that strategy at that point, right? So if the stock has moved in your favor, you might want to adjust, the strategy so that you are, so that you are kind of recentering the trade after earnings, for the directional view that you might have at that point, especially with the new information that has come out, hopefully confirming your original view, that allows you to basically, roll out the contract and basically continue to either collect more premium, or capture some more upside in that particular stock. I appreciate the knowledge. Any advice for earnings if someone doesn't have 100 shares of cash secured money? Well, in both of these strategies that I just showed you, you don't need, anywhere near 100 shares of, the cash to buy 100 shares, right? So T-Mobile is a $226 stock. So, 100 shares is $22,000. You only need $259 to trade this debit spread. That's basically that's a little over 1% of the stock's value. That's all you need. So with these types of strategies, the capital requirements are very, very low relative to, the cash required to buy 100 shares. If you look at this credit spread here on T-Mobile, the maximum risk here is $880. That's all you need to trade one contract is $880. On a $226 stock, that's about 3% of the stock's value. So, like I said, you don't need anywhere near 100%, 100 shares of the stock in cash in order to trade this. And that's one of the key benefits of what people like about options is how capital efficient it is while getting exposure to roughly 100 shares of the stock. Hopefully that answers your question, Michael. I think that if you have a small account and you're trying to turn earnings, this is exactly how you would do it. I'm expecting the price to increase after the earnings date, but it doesn't make sense to buy a call option expiring the week after earnings. Generally speaking, I recommend doing at least the week, if not the week after earnings, in terms of expiration dates. As you can see in my examples, I'm going out, in the debit spread about 15 days after the earnings. In the credit spread, I'm going out even further. So yeah, you generally want to go out at least 1, if not 2 weeks post the earnings for your expiration dates. Okay. I hope that this is helpful in giving you a better understanding on navigating earnings season. Please, uh, there's a lot happening. Try to keep a cool head. Use a defined process, and as like I said, with a defined process, about 98% of options are earnings announcements end up being ones that you don't trade. But if you can just find a few good ones, that's really all you need for earnings season. And this is hopefully going to give you a process by which that you can help identify some of those really strong candidates. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.